You finished school, you started working, you're even paying taxes, but you still feel as if you don't know much about how to manage your own money. The basics are just not there. Many of us graduate with little to no idea on how to earn, spend, save, and most importantly, invest. So let's teach you some fundamental concepts. Hi everybody, welcome back to NAGA's channel. My name is Michalis and I'm the market analyst here, and I'm super excited for you to join our brand new NAGA Academy series. Today's episode, what you didn't know about managing your money. Before we start, make sure you hit the subscribe button and turn on the notifications to never miss a new episode. So let's begin. Lesson 1. You graduate from university, you earn your first salary, but you don't actually know what you should be doing with it. Don't worry, you are not alone. Unfortunately, school tends to skip this part. I guess you're thinking about how to manage your debt, save, and if you should be investing. Of course, these are definitely something you need to consider, but there are a few things that you should first know about managing your money in 2023. Throughout 2022, the only thing that we were hearing is about recession and the cost of living going up. Well, the thing about 2023 is that none of that is likely to change anytime soon. So the issue about 2023 is that the cost of living has become super expensive, specifically rent, fuel, and the cost of debt. At the same time, our savings accounts are still not offering much and wages are just not keeping up. On average, everything has become 10% more expensive, and in some cases it's actually more like 30%. So whatever your salary is or your savings are, well, they are actually losing 10% a year without you even realizing it. For example, $10,000 in a savings account in 2021 is actually $9,000 in 2023. Okay, I think everyone just got a little bit dizzy. So this means that we need to make some changes to the way we manage our money. We in the financial market say you reap what you sow. This basically means if you don't do nothing, expect nothing in return. So what is the answer to your problems? Well, there is a few simple steps to consider, but first it's important that you identify what are the problems that you're trying to fix. The first concern is inflation, which basically is the increase in the cost of living. This is a big issue. Second, the cost of debt is 4 times more expensive in 2023. And the last issue is that most young adults want to be investing but don't know how to invest responsibly. The biggest issue at the moment is rent. As a financial advisor in the UK, I always told my clients that rent will put you back 5 years. The bad thing about rent is that the cost has gone up 18%, which is ridiculous. And the worst thing is that it is money that you will never get back. In simple terms, you are throwing money away. So if you can, stay at home for as long as you can and save the money that you would have been spending on rent, and then buy your first property. Most European countries only require a deposit to purchase your first property of 10%, which is doable if you are saving as much as you would have been paying on rent. The second issue is the cost of debt. Most young adults tend to fall into the trap of expensive debt. These tend to fall into 3 major categories: overdrafts, credit cards, and payday loans. These are easy to obtain, which is why most young people turn to them, but most of the time they are unnecessary expensive liabilities. A credit card on average can charge 30%, an overdraft can charge up to 300%, and payday loans can be even higher if you are not paying back in the same month. So before you start saving, which is only going to earn you 1% on average, it is better to get rid of all your expensive debt, starting with the one with the highest fees. Now we come to the interesting part: investing. Something that not a lot of young adults know is that there's 3 categories which investments fall into: low risk, moderate risk, and high risk. An example of low risk is investing in bonds, which is safe and pays a very low interest. Cryptocurrencies, on the other hand, are considered high risk because they are volatile. For example, the price of Bitcoin declined by 60% in 2022, but increased by 170% over the past 5 years. A cryptocurrency is simply a digital currency which does not go through a bank. For example, Bitcoin, Ethereum, and Dogecoin. So one sounds boring and the other one may sound slightly scary. So what do young adults have to consider? Well, the moderate category actually tends to form the most sought after investments, especially by professionals. This category is mainly made up of properties, stocks, ETFs, and indices. Stocks actually allow you to own a portion of a company such as Apple, Tesla, and Netflix. You get paid a percentage of the company's profits 4 times a year, and you can also benefit from the price of the stock increasing as well. Indices are also a great way to invest in stocks. An index is an asset which includes multiple well-known stocks. You are able to invest in many stocks at the same time and claim a piece of all of their profits. Also, indices are considered to be a lower risk category because if one of the companies go bankrupt, they simply are replaced with another company which has a strong growth prospects. This way, the price doesn't get negatively affected in the long term, and technically speaking, the investment can never reach zero. One of the most popular indices is the Nasdaq. The Nasdaq is a group of 100 companies from the US technology sector and has increased by 80% since 2018. So we know why money management is vital in 2023. Don't let the economy and bankers take you on a ride. Take the right steps to ensure that in 5 to 10 years you have less debt, less stress, and ensure that inflation is not eating into your pockets. And remember, whatever we say here is not financial advice. Always make sure that you do your research before getting into an investment. That's all for today. Class dismissed.